Before we dive in, please remember that I am not a licensed financial advisor or insurance professional. This presentation is for educational and informational purposes only. The information provided is based on research and experience, but it should not be considered professional financial or legal advice. Always consult with a qualified and licensed insurance agent in your state to discuss your specific needs and circumstances before making any policy decisions. Your financial situation is unique, and you deserve personalized advice. Did you know that nearly half of all American drivers are overpaying for their car insurance? I'm not talking about a few bucks here and there. I'm talking about an average of $531 a year. Let that sink in. $500. That's a new set of tires. A weekend getaway. That's money that could be in your savings account, invested for your future, or used to pay down debt, but instead it's just gone, vanishing into the billion-dollar marketing budgets of massive insurance companies. And the most infuriating part? Most people have absolutely no idea it's happening to them. They're unknowingly paying what the industry calls a loyalty tax. You know the feeling. You get that email and your stomach does a little flip. The subject line says, "Your auto policy is about to renew." You click it open, you scroll past all the corporate fluff, and there it is, the new premium. And it's higher. Again, for no good reason. You haven't had an accident. You haven't gotten a single ticket. Your car is a year older and worth less, so why on earth are you being asked to pay more? You let out a sigh, close the email, and you make a promise to yourself. This is the year. I'm finally going to shop around. But then life gets in the way. The kids have practice, that project at work is due, and the mental energy it takes to untangle the web of quotes and coverages just feels overwhelming. So the renewal date comes and goes, the auto payment hits your account, and the insurance company wins. Again, this video is the antidote to that feeling of helplessness. This is your step-by-step, no-nonsense guide to breaking that cycle for good. We are going to pull back the curtain on the auto insurance industry. I will give you the exact playbook I have used to save thousands of dollars over the years, and I'll show you how to find not just the cheapest insurance, but the right insurance for you near you without spending weeks on the phone getting harassed by sales agents. By the end of this guide, you won't just be a smarter insurance shopper. You'll be in complete control of one of your biggest household expenses. You will know exactly what you're paying for, why you're paying for it, and you'll have the confidence to know you're getting the best possible deal. We're going to tackle this in 3 simple phases. First is the prep, where we build our foundation. Second is the hunt, where we strategically gather our ammunition, the quotes. And third is the final battle, where we compare those quotes like a pro and make our decision. Today we are starting with the most important phase of all, the prep. Because going into the insurance market unprepared is like walking into a car dealership without knowing what car you want or what your budget is. You are guaranteed to get taken for a ride. So the very first step in our prep phase is to bust a massive, dangerous myth that costs people fortunes. It's the myth that the cheapest insurance is the best insurance. People think, I'll just get the state minimum coverage. It's the law, and it's the lowest price, so I'm good. This is without a doubt one of the biggest financial mistakes you can make. Choosing state minimum coverage is like deciding to protect your life savings with a piggy bank. It technically holds money, but it offers absolutely zero real protection from a serious threat. It checks a legal box, but it leaves you one bad day, one single accident away from financial ruin. So what do? We start by understanding what we actually have right now. I want you to pause this video in a moment and go find your current auto insurance policy. What you're looking for is a specific document, usually right at the front, called the declarations page. This single page is the Rosetta Stone of your insurance. It lists who is covered, what cars are covered, and most importantly, the specific types of coverage you are paying for and their limits. It might look like a bunch of confusing numbers and jargon right now, but we're about to decode it together. Got it? Okay, great. Look at that page. You're going to see a few key sections. The first, and arguably the most important, is liability coverage. This is the coverage that pays for the damage you do to other people and their property if an accident is your fault. It's usually written as a series of 3 numbers, like 50/100/50. This isn't just random code. It represents thousands of dollars. The first number is the maximum amount. In thousands, your policy will pay for any single person's bodily injuries. The second number is the max it will pay for all bodily injuries in a single accident. And the third is the max it will pay for property damage, think cars, mailboxes, guardrails. So, if you have state minimum coverage in, say, California, your numbers might be 15/30/5. That's $15,000 for one person's injuries, $30,000 total for injuries, and a measly $5,000 for property damage. Now picture this, you have a momentary lapse in attention, you run a red light and you T-bone a brand new Tesla. The driver has a broken arm and a concussion. The Tesla is totaled. The medical bills alone could easily exceed $50,000. The car itself is worth $60,000. Your policy pays out its max. $30,000 for the injuries and $5,000 for the car. That leaves a shortfall of $75,000. 75 grand. Guess who's on the hook for that? You are. They can sue you for it. They can go after your savings, your investments, even garnish your future wages for years to come. That cheap state minimum policy just became the most expensive decision of your life. The next two lines you'll see are likely collision and comprehensive. This is the coverage that protects your car. They're often confused, but it's simple. Collision pays to fix your car when you hit something else, whether it's another car, a tree, or a pole. It's for when the accident is your fault. Comprehensive is for almost everything else. Think of it as the bad luck and acts of God coverage. A tree branch falls on your roof during a storm. Hail turns your hood into a dimpled mess. A deer decides to play chicken with your front bumper. Your car gets stolen. That's all comprehensive. For both of these, you'll also see a deductible. That's the amount of money you have to pay out of pocket before the insurance company pays a dime. A higher deductible means a lower monthly premium, but more pain if you have to file a claim. Finally, look for uninsured or underinsured motorist coverage, often abbreviated as UM/UIM. This is one of the most critical and overlooked coverages you can have. This protects you when the person who hits you either has no insurance at all, or they have that cheap state minimum junk we just talked about that can't even begin to cover your medical bills or lost wages. You're a responsible driver with good coverage, but what about the millions of others on the road who aren't? This coverage is you insuring yourself against their irresponsibility. So now look at your declarations page again. Look at those liability numbers. Look at your deductibles. Look at whether you even have uninsured motorist protection. And ask yourself the real honest question. If I caused a serious accident tomorrow, or if I were the victim of one, would this be enough? Is this enough to protect my savings, my home, my family's financial future? Because finding affordable auto insurance isn't just about finding the lowest number. It's about finding the absolute best value. The most protection for your family, for the lowest possible price. And now that you understand what you have, you're ready for the next step. Figuring out what you actually need. So let's talk about what you actually need. And this right here is the single most important step in this entire process. It's where people make the biggest, most catastrophic mistakes. They fall into a trap that's set by the very system designed to protect them. And that trap is called state minimum coverage. Every state has a minimum amount of insurance you're legally required to carry to drive a car. Sounds official, it sounds safe. But let me be crystal clear. State minimum coverage is a financial time bomb. It is not designed to protect you. It is designed to be the absolute, bare-bones, rock-bottom legal requirement to let you put your key in the ignition. It's a suggestion, and a terrifyingly bad one at that. Think about your state's minimum for property damage. In many states, it's just $10,000 or $15,000. Some are as high as $25,000. Now look around you on your next commute. The average price of a new car in America is now close to $50,000. You see Teslas, new F-150s, BMWs everywhere. What happens if you have a simple fender bender, and it's your fault and you total one of those cars? Your $15,000 property damage limit is gone in an instant. And that remaining $35,000? That's on you. The insurance company pays its legal limit, wishes you luck, and walks away. Suddenly, you're facing a bill that could bankrupt you. All because you thought state minimum meant state approved. It's even worse with injuries. A state minimum for bodily injury might be $25,000 per person. Do you know how fast $25,000 disappears after an ambulance ride, an emergency room visit, and a few follow-up appointments? It's a rounding error in a serious accident. If the person you hit has to miss work, needs surgery, or has long-term pain, their lawyer won't stop at $25,000. They'll come after your savings, your paycheck, your house, everything you've worked for. So, we are not building a policy based on the state minimum. We are throwing that idea in the trash. Instead, we are going to build a fortress, your own personal fortress of financial security. And every type of coverage is a different part of that fortress. Let's start with the most important part, the outer walls. This is your liability coverage. This coverage doesn't protect you or your car. It protects you from the rest of the world when an accident is your fault. It pays for the other person's car repairs and their medical bills. This is what stands between a simple mistake and losing everything you own. Liability coverage is always shown as three numbers, like 50/100/50. It's confusing, so let's break it down. The first number is the maximum amount, in thousands, your policy will pay for a single person's injuries. The second number is the maximum for all injuries in a single accident. And the third number is the maximum for all property damage. So a 50/100/50 policy means your insurance will pay up to $50,000 for one person's injuries, but no more than $100,000 total for everyone you injure in one crash, and up to $50,000 to fix or replace their cars and property. Now, is 50/100/50 enough? For most people, absolutely not. We already saw how a $50,000 property damage limit can be wiped out by one single new truck. A good starting point, a strong set of walls for your fortress, is 100/300/100. That's $100,000 per person, $300,000 per accident, and $100,000 for property damage. If you own a home or have significant savings, you should be looking at 250/500/100 or even higher. The price difference to go from a weak, flimsy state minimum policy to a truly protective 100/300/100 policy is often just a few dollars a month. It is the single best investment you can make in your financial security. Do not skimp on your fortress walls. Okay, so the walls are built to protect you from the outside world. Now, what about protecting the castle itself? Your car. This is where collision and comprehensive coverage come in. Collision is simple. It pays to repair or replace your car if you hit something. Another car, a pole, a guardrail. It's for when you are the cause of the collision. Comprehensive is for almost everything else. Think of it as acts of God or bad luck coverage. A tree falls on your car. A hailstorm turns your hood into a golf ball. A deer runs out in front of you. Your car gets stolen. That's all comprehensive. With both of these, you have a deductible. This is the amount of money you have to pay out of pocket before the insurance company pays a dime. A common deductible is $500 or $1,000. If you have a $500 deductible and do $4,000 worth of damage, you pay the first $500, and the insurance company pays the remaining $3,500. Here's the secret. Raising your deductible from, say, $500 to $1,000 can save you a significant amount of money on your premium. It's a trade-off. You're taking on a little more risk. Can you afford to shell out $1,000 tomorrow if you have to? In exchange for a lower bill every month. But here's an even bigger question. Do you even need collision and comprehensive? If your car is financed or leased, the answer is yes. The bank requires it. But if you own your car outright, it's your choice. And here's a powerful rule of thumb. If the annual cost for your collision and comprehensive coverage is more than 10% of your car's cash value, it might be time to drop them. If your car is only worth $3,000, and you're paying $500 a year for this coverage, you're paying a huge premium to protect a small asset. You could just bank that $500 a year for future repairs or a down payment on a new car. Next, we need to build the watchtowers and arm the guards. This is your uninsured and underinsured motorist coverage. And this is critically important. Statistics show that roughly 1 in every 8 drivers on the road with you right now has zero insurance. And many more have only that laughably low state minimum coverage we talked about. What happens if one of them runs a red light and plows into you? They have no insurance or not enough to cover your medical bills, your lost wages, your pain and suffering. They might get a ticket, but you get stuck with the bills. Unless you have uninsured motorist coverage. This is insurance you buy to protect yourself from other people's irresponsibility. It steps in and acts as the other driver's insurance, paying for your injuries and damages. It is shockingly affordable, and in my opinion, it is non-negotiable. You should always carry uninsured and underinsured motorist coverage at the same limits as your own liability coverage. If you have 100/300 on your liability, get 100/300 for this. You are protecting yourself and your family. Now for the Fortress Infirmary, the medics who treat your own people. This is medical payments coverage, or in some states, personal injury protection, also known as PIP. This covers medical expenses for you and your passengers, no matter who was at fault in the accident. It's primary coverage, meaning it pays out before your health insurance does, and there are no deductibles or copays. It can cover things your health insurance might not, like dental work or, in the worst-case scenario, funeral expenses. PIP, which is required in no-fault states, is even broader and can also cover lost wages. Even if you have great health insurance, a few $1,000s in MedPay or PIP is a smart, inexpensive buffer that gives you immediate access to care without any out-of-pocket costs. Finally, we have the Castle's support staff, the nice-to-have extras. This is stuff like rental reimbursement and roadside assistance. Rental reimbursement gives you a rental car while yours is in the shop after a covered claim. It's usually cheap, but ask yourself, do you have another car you could use? Could you work from home? If not, it's probably worth it. Roadside assistance is for lockouts, flat tires, and towing. It's also cheap, but many people already have this through their credit card or a service like AAA. Check first so you're not paying for the same service twice. So let's recap your fortress. You need strong outer walls, high liability limits, at least 100/300/100. You need to decide if you need to protect the castle itself with collision and comprehensive, based on your car's value and your deductible tolerance. You absolutely need watchtowers and guards, uninsured and underinsured motorist coverage to match your liability limits. And you should have an infirmary, a solid medical payments or PIP policy. You're not just buying car insurance. You're building a personalized plan. You're making conscious decisions about risk, cost, and protection. And now that you've built the blueprint for your perfect policy, you have your personal shopping list. But where do you take that list? How do you find the companies that will give you the best price for this exact fortress of protection? That's where the real game begins, and it's where we separate the amateurs from the pros who save hundreds, even thousands of dollars a year. The first, most critical step is to understand the battlefield. You need to know who the players are. Most people think of 3 or 4 companies they see on TV, get a quote from one of them and call it a day. That, right there, is the amateur move. That's how you end up overpaying by 30, 40, even 50%. The professional understands that the insurance landscape is vast and varied. It's a complex ecosystem of giants, local specialists, and digital disruptors. Your job isn't to just pick one. It's to make them compete for your business. To do that, you need to build what I call your quote hit list. This is a strategic list of at least 8 to 10 companies you will target for a quote. Not 2, not 3, 8 to 10. This is non-negotiable. This single step will save you more money than any other. So, how do we build this list? We divide it into 4 distinct categories. First, you have the national Goliath. These are the household names. The companies spending billions on commercials with catchy jingles, celebrity spokespeople, and talking lizards. You know who they are: Progressive, Geico, State Farm, Allstate, Liberty Mutual. You absolutely must include these on your list. Why? Because they are massive. They have enormous pools of customers, which means they have sophisticated algorithms that are very, very good at pricing risk. For some people, maybe even you, they will genuinely offer the best price. They have the brand recognition, the financial stability, and often a massive network of agents and claims adjusters, which can be a huge comfort when something goes wrong. Think of them as the baseline. They are the established market price. You need their numbers to know what you're trying to beat. But make no mistake, stopping here is like walking into a supermarket, only looking at the items on the end cap display and then leaving. You're missing 90% of the deals. The second category on your hit list is where the real treasure is often buried. These are the regional champions. These are insurance companies that don't operate in all 50 states. Instead, they specialize in a specific region or sometimes just a single state. Names you might hear are Erie Insurance in the Mid-Atlantic, NJM in New Jersey, Auto Owners in the Midwest and South, or Wawanesa in California and Oregon. Most people have never heard of these companies, and that is their superpower. Because they focus on a smaller geographic area, they understand the local risks, driving conditions, and legal environments better than anyone. They don't have to price for the hurricane risk in Florida if they only operate in Wisconsin. They don't have to factor in the blizzard risk of North Dakota if they only serve Arizona. This specialization means their overhead is often lower, and their pricing can be surgically precise and frequently much, much cheaper. And here's the kicker. These regional companies often have the best customer service in the entire industry. Year after year, when J.D. Power and other consumer rating agencies release their rankings for claims satisfaction, it's these smaller, regional players that dominate the top of the lists. They're the neighborhood restaurant that knows your order by heart versus the giant, faceless fast food chain. So how do you find them? It's simple. You go to your favorite search engine and you type in top-rated auto insurance in your state. Don't just type car insurance. Add the top-rated qualifier. This will bring up articles and lists that specifically highlight these high-performing local gems. Find 2 or 3 of these highly rated regional champions that serve your state and add them to your hit list immediately. This is a pro-level move that 99% of people skip. The third category is the digital disruptors. These are the new kids on the block, the tech-forward online-only insurers. Companies like Lemonade, Root, or Metromile. Their entire business model is built on cutting out the overhead of brick-and-mortar offices and large agent networks. They operate through slick, easy-to-use apps on your phone. Their pitch is simple. By using technology, AI, and sometimes new ways of measuring risk, they can offer lower prices. For example, some of these companies offer what's called usage-based or telematics insurance. This is where they use an app on your phone or a device in your car to monitor your actual driving habits. How fast you accelerate, how hard you brake, how often you drive late at night. If you're a safe, low-mileage driver, this can translate into massive savings because you're not subsidizing the risk of more aggressive drivers. Now, this isn't for everyone. The idea of being tracked can be unsettling for some. And because they're newer, their claims process might not be as time-tested as the 100-year-old giants. But for the tech-savvy, safe driver, the potential savings are too significant to ignore. You need to get at least 1 or 2 quotes from this category to see if their modern approach benefits your wallet. Add a couple of the best-known digital players to your hit list. That brings us to our fourth and final category. This isn't a type of company, but rather a type of access. It's your secret weapon, your ace in the hole. It's the independent agent. This is fundamentally different from calling an agent for, say, State Farm or Allstate. Those are called captive agents. They work for one company and one company only. They can sell you any State Farm policy you want, but they can't sell you a Progressive or an Erie policy. An independent agent, on the other hand, works for you. They are not beholden to any single insurance company. They are licensed to represent multiple carriers, sometimes dozens of them. They are like a master key that can unlock doors you didn't even know existed. You give them your information one time, and they will shop it across their entire network of insurers. This network often includes many of those regional champions we just talked about, plus other carriers that don't even sell directly to the public. They only work through agents. Think of it this way. Getting quotes yourself is like going to each airline's website one by one to find the cheapest flight. It works, but it's time-consuming. Using an independent agent is like using a powerful flight aggregator that checks hundreds of sites in an instant, including smaller charter airlines you've never heard of. They know the market. They know which companies are currently offering aggressive rates for someone with your exact profile, your car, your driving record, your zip code. They do the legwork for you. Finding one is easy. The Independent Insurance Agents and Brokers of America has a website called Trusted Choice. You can go there, enter your zip code, and it will give you a list of vetted local independent agents near you. Your mission is to find one of these agents, call them, and have them run the numbers for you. This single call is the equivalent of getting 5, 10, even 15 quotes at once. So let's recap your quote hit list. You should have 3 to 4 of the national Goliaths, 2 to 3 of the top-rated regional champions in your state, 1 or 2 of the digital disruptors, and you will have 1 independent agent working on your behalf, shopping the market for you. This gives you a comprehensive, multi-pronged attack. You're covering the big brands, the local specialists, the tech innovators, and the hidden agent-only market. You are now casting a net so wide that it is almost statistically impossible for the best rate to escape you. You've gone from a hopeful amateur taking the first offer you see to a strategic professional orchestrating a competition for your business. Now you have your list. You have your targets. You're ready to engage. But before you pick up the phone or start typing in your information online, there's one more crucial step of preparation. You need to gather your dossier. You need to have every piece of information they are going to ask for ready, organized, and accurate. Because every single detail, from your exact mileage to your VIN number, is a lever that can either raise or lower your price. And going into these conversations unprepared is like walking into a negotiation without knowing your own numbers. It's a guaranteed way to leave money on the table. So what are those numbers? What's in the secret playbook that determines whether you pay $800 a year or $3,000 a year for the exact same car and the exact same driver? It's time to pull back the curtain, because insurance companies have created a complex profile on you, a financial fingerprint that goes far deeper than just the year, make, and model of your vehicle. The first, and for many people the most shocking factor, is your credit score. Yes, you heard that right. In almost every state, Your credit history is one of the single most powerful predictors of your insurance premium. Now you might be thinking, what on earth does my Visa bill have to do with my ability to merge onto a highway? And that's a fair question. The answer lies in a mountain of data. Insurers, who are fundamentally in the business of predicting risk, have found a strong statistical correlation between how people manage their finances and how likely they are to file a claim. They don't look at your FICO score directly. Instead, they use a proprietary credit-based insurance score. They look at factors like your payment history, your outstanding debt, the length of your credit history, and applications for new credit. To them, a person with a low score is seen statistically as a higher risk. It's not a judgment on your character. It's a cold, hard calculation. Let me paint a picture for you. Imagine two identical twins, Mark and David. They live next door to each other, they drive identical 2022 Honda Accords, they have the exact same job, and they both have perfectly clean driving records. Not a single ticket or accident between them. But Mark has a credit score of 780, while David, after a few tough years, has a score of 580. When they call for quotes, Mark is offered a rate of $120 a month. David is quoted $250 a month. That's more than double. An extra $1,560 a year for the exact same risk on the road. This isn't an exaggeration. It's a daily reality in the insurance world. Your financial health is directly tied to the cost of being on the road. So if you're planning to shop for insurance, step one, before you even think about calling an agent, is to know your credit score and take steps to improve it if you can. Next up is your driving record. But we need to go deeper than just don't get tickets. What truly matters is the look-back period. Every insurance company has a window of time they care about, typically 3 to 5 years. A speeding ticket you got 4 years ago might still be haunting your rates today. A more serious violation like a DUI or a reckless driving charge can stay on your record for 7 years, 10 years, or even longer in some states, acting like a lead weight on your premium. It's crucial to understand the hierarchy of violations. A non-moving violation like a parking ticket usually has zero impact. A minor moving violation like a speeding ticket for going 10 miles over the limit will cause a noticeable bump. But an at-fault accident? That's a major event. It signals to the insurer that you've cost them, or another insurer, a significant amount of money. The first at-fault accident can sometimes increase your premium by 40% or more. A second one within that 3 to 5 year window can put you into a high-risk category, potentially doubling your rates or even making you uninsurable with standard carriers. So when you prepare to shop, get a copy of your motor vehicle report or MVR. Know exactly what's on there and, most importantly, when each incident occurred. If you have a ticket that's about to fall off the 3-year mark in 2 months, waiting to shop for a new policy could literally save you hundreds of dollars. Timing is everything. Now let's talk about a factor that feels incredibly unfair to most people, but is brutally effective for insurers: your zip code. Where you park your car at night can have as much of an impact on your rate as how you drive it during the day. This isn't about whether you live in a good or bad neighborhood in the traditional sense. It's about data. Insurers track every single claim and they know, down to the specific zip code, the frequency of theft, vandalism, and fraudulent claims. They know the statistics on weather-related damage, like hail or flooding. They also track the frequency of accidents in your area. Living near a particularly dangerous intersection can raise your rates. They even look at the cost of vehicle repairs in your local area. A body shop in Beverly Hills charges a lot more than one in rural Kansas, and that gets baked into the price. And finally, they look at litigation rates. Some areas are more prone to lawsuits after an accident, driving up the potential payout for an insurer and, therefore, your premium. You could live in one zip code and pay a certain rate, then move 2 miles down the road into a new zip code, and see your premium jump 20% overnight, even if nothing else in your life has changed. It's a postcode lottery, and it's a powerful reminder that insurance pricing is less about you as an individual and more about which statistical box you fit into. This brings us to one of the most critical and misunderstood factors: your coverage history. There are 2 giant traps here. The first is the loyalty trap. Many of us believe that staying with the same insurance company for 5, 10, or 15 years will earn us the best rates. While you might get a small loyalty discount, the reality is often the opposite. Many insurers practice something called price optimization. They slowly increase your rates year after year, betting that you won't go through the hassle of shopping around. That small 4% increase each year doesn't feel like much, But after a decade, you could be paying significantly more than a new customer would for the exact same policy. Loyalty in this industry is often penalized, not rewarded. The second and far more dangerous trap is the lapse penalty. Letting your auto insurance coverage lapse, even for a single day, is one of the most expensive mistakes you can make. When you go to buy a new policy, insurers will see that gap in coverage. To them, a driver without continuous insurance is a massive red flag. They are considered a much higher risk and your rates will skyrocket. It signals instability, and it can cost you dearly for years to come. If you're selling a car and plan to buy a new one in a few weeks, do not cancel your policy. Get a non-owner policy to bridge the gap. Whatever you do, maintain continuous coverage. Finally, there's a whole constellation of smaller factors that all get thrown into the algorithm. Your marital status matters. Married individuals are statistically less likely to be in an accident and therefore get lower rates. Whether you're a homeowner or a renter matters. Homeowners are seen as more stable and get a discount. Even your occupation and level of education can play a role. Actuaries have found correlations between certain professions, like engineers and teachers, and safer driving habits. All of these data points, your credit, your driving record, your location, your coverage history, your marital status, your homeownership, are fed into a complex computer algorithm. It chews on this data and spits out a single number: your premium. It's not personal, it's just math. Understanding this playbook is your first step to winning the game. You now know what they're looking at. You know which levers you can pull, like improving your credit or waiting for a ticket to age off your record, and which ones you can't, like where you live. You're no longer negotiating in the dark. But knowing how they price you is only half the battle. The other half is knowing what you're actually buying. Because the terms liability, collision, comprehensive, and full coverage are thrown around all the time. But most people have a dangerously vague understanding of what they truly mean. And choosing the wrong combination of coverages isn't just a matter of paying a few extra dollars. It can be the difference between a minor inconvenience and total financial ruin. So let's talk about that ruin. Let's make it real. Imagine you're driving home on a rainy Tuesday. You glance down at your phone for a split second, just a second, to check a notification. When you look up, brake lights flash red. You slam the brakes, but it's too late. The crunch of metal is sickening. You've just rear-ended a brand new Mercedes. The driver gets out, a well-dressed lawyer clutching his neck. His passenger, a surgeon, is complaining of back pain. Your 10-year-old sedan has crumpled their bumper and trunk, but that's the least of your problems. You have the state minimum liability coverage because you wanted the cheapest policy possible. You thought you were being smart, saving $100 a year. But your policy only covers $25,000 for bodily injury per person and $50,000 total per accident. The lawyer's whiplash claim and a few weeks of missed court appearances? That's easily $30,000. The surgeon's back injury with MRIs, physical therapy, and lost income from canceled operations? That could be $100,000 or more. Your $50,000 limit is exhausted almost instantly. The remaining $80,000? That's on you. The repairs to the Mercedes? Your $10,000 property damage limit won't even cover the cost of the high-tech taillights. The other $20,000 in repair costs? That's on you too. Suddenly, you're facing a $100,000 bill. They sue you. Your wages are garnished. A lien is put on your house. Your savings are wiped out. Your future is mortgaged to this one split-second mistake. All to save the price of a few cups of coffee a month. That is the difference between a piece of paper that meets a legal requirement and an actual financial shield. Understanding what follows in the next few minutes is the most important financial decision you might make all year. Let's build your shield piece by piece, starting with the absolute foundation. It's called liability coverage. This is the part of your insurance that is, in most states, non-negotiable. You must have it. But here's the single most misunderstood fact about it. Liability coverage is not for you. It does not pay to fix your car. It does not pay your medical bills. It pays for the damage you do to other people and their property. It protects your assets, your savings, your home, your future income from being seized to pay for the harm you caused. It's broken into two parts: bodily injury liability, which covers medical bills, pain and suffering, and lost wages for people you injure, and property damage liability, which covers repairs to the other person's car, or their fence, or the storefront you might crash into. When you see those three numbers on a policy like 25/50/25, that's what they mean. In this example, your policy would pay up to $25,000 for a single person's injuries, a maximum of $50,000 for all injuries in one accident, and up to $25,000 for property damage. As we saw in our nightmare scenario, these state minimum numbers are terrifyingly low. A modern car can easily cost more than $25,000 to repair, and a single moderate injury can skyrocket past that limit. The first rule of not going broke from a car accident is to get liability limits that are significantly higher than your state's minimum. We're talking 100/300/100 as a solid starting point. Costs more, yes, but the peace of mind is priceless. Okay, so liability protects your bank account from everyone else. But what about your own car? If you cause that accident, who pays to fix your crumpled fender? That's where collision coverage comes in. This is the coverage that pays to repair or replace your vehicle if you're in an accident with another object, be it another car, a guardrail, a telephone pole, or even a particularly nasty pothole. Collision is optional unless you have a loan or lease on your car, in which case the lender will require it to protect their investment. When you buy collision, you'll also choose a deductible. This is the amount of money you have to pay out of pocket before the insurance company pays a dime. A common deductible is $500 or $1,000. So, if you have a $1,000 deductible and cause $5,000 of damage to your car, you pay the first $1,000, and the insurance company pays the remaining $4,000. The higher your deductible, the lower your premium will be, because you're agreeing to take on more of the initial financial risk yourself. A key strategy here: if you're driving an old car that's only worth, say, $2,000, paying for collision coverage with a $1,000 deductible might not make sense. You could be paying hundreds a year to protect a $1,000 potential payout. Next up is collision's close cousin, comprehensive coverage. I like to call this the acts of nature and nefarious humans coverage. Comprehensive pays for damage to your car from almost anything other than a collision. This is the coverage that saves you when a tree branch falls on your roof during a storm. It's what you need when a deer decides to play chicken with your grill at 60 miles per hour. It covers theft, vandalism, fire, flooding, and hail. If you wake up to find your window smashed or your car gone, you'll be calling your insurance company to make a comprehensive claim. Just like collision, it's usually optional unless you have a loan, and it also comes with a deductible you have to pay first. Many people bundle collision and comprehensive together, and it's often referred to as full coverage, even though that's not an official term. Now we get to one of the most important and tragically overlooked coverages you can buy. Let's flip our nightmare scenario. This time, you're the one stopped at the red light. You're doing everything right. Suddenly, you get slammed from behind by someone texting and driving. Your car is totaled, you have a severe concussion and 3 herniated discs. The other driver is at fault 100%. But then comes the gut punch. They don't have insurance. Or they have the pathetic state minimum, which won't even cover the cost of your ambulance ride. What happens now? You're injured, out of work, with a mountain of medical bills and no car. And the person who did this to you has no money and no insurance to pay for it. Feels like a cruel joke. This is where uninsured and underinsured motorist coverage, or UM/UIM, becomes your personal superhero. This coverage steps in and acts like the at-fault driver's insurance, paying for your medical bills, your lost wages, and in some states, the repairs to your car. It is you, the responsible person, buying insurance for the possibility of getting hit by an irresponsible one. And considering that the Insurance Research Council estimates that about 1 in 8 drivers in the US is uninsured, this isn't a remote possibility. It's a daily risk. Skipping this coverage to save a few dollars is one of the biggest gambles you can take. Finally, let's talk about your body directly. We have 2 last key coverages: medical payments, or MedPay, and personal injury protection, or PIP. They're similar, but with important differences. MedPay is straightforward. It covers medical and funeral expenses for you and your passengers up to a certain limit, typically $1,000 to $10,000, regardless of who was at fault in the accident. It's designed to provide immediate funds for things like health insurance deductibles, co-pays, or ambulance fees, without waiting for a lengthy fault determination. Personal injury protection, or PIP, is required in what are called no-fault states. It's like MedPay on steroids. Not only does it cover medical bills for you and your passengers regardless of fault, but it also extends to cover things MedPay doesn't, like lost wages if you can't work, and the cost of hiring someone to perform essential services you can no longer do, like childcare or housework. In a no-fault state, you first turn to your own PIP coverage for your injuries, which helps streamline the claims process and get you paid faster. So there you have it. liability, collision, comprehensive, uninsured motorist, and MedPay/PIP. These aren't just confusing terms on a declaration page. They are the individual components of your financial armor. Each one protects you from a different kind of disaster. Choosing correctly isn't about picking the cheapest option. It's about understanding the risks you face every time you turn the key and building a shield strong enough to withstand them. But knowing what these coverages are is only half the battle. The other half, and the part where people either save a fortune or leave themselves dangerously exposed, is choosing the right limits and deductibles for each one. Let's break this down into two simple concepts: limits and deductibles. Think of it like this. A limit is the absolute maximum amount your insurance company will pay out for a claim. It's their ceiling. A deductible is the amount of money you have to pay out of your own pocket first, before your insurance company pays a single dollar. It's your floor. Getting these two numbers right is the secret to having a policy that actually works in the real world without costing you a fortune. Let's start with the most important one: liability limits. This is the money that pays for the damage you cause to other people and their property. Every state has a legal minimum amount of liability coverage you're required to carry. And I'm going to tell you something that might sound controversial. State minimum liability is a trap. It is a financial time bomb. It's designed to be the absolute bare minimum to make you legal to drive, not to actually protect you in a modern accident. Relying on state minimums is like going into a sword fight with a butter knife, because the law only required you to bring a blade. Let me paint you a picture. Meet Mark. Mark is a smart guy, 28 years old, has a decent job in IT, and drives a 3-year-old Honda Accord. He's a safe driver, no accidents. When he shops for insurance, he sees that he can save about $30 a month by choosing his state's minimum liability coverage instead of a higher option. The minimums in his state are 25/50/25. That means his policy will pay a maximum of $25,000 for bodily injury to one person, a maximum of $50,000 for bodily injury to everyone in the entire accident, and a maximum of $25,000 for all property damage. Mark thinks, 25 grand? That sounds like a lot of money. I'm a safe driver anyway. I'll take the savings. $30 a month is $360 a year. He can put that toward a vacation. Seems like a smart move. One Tuesday afternoon, Mark is driving home from work. It's raining lightly. He's thinking about a project deadline, and for just a split second, he glances down at his phone to see if his boss emailed him. In that 1 second, the traffic ahead of him has stopped. He slams on the brakes, but the wet pavement isn't forgiving. He rear-ends a brand new Toyota Highlander. The impact is hard enough to push the Highlander forward into the back of a Lexus sedan in front of it. It's a classic 3-car, chain reaction fender bender. Nobody seems seriously hurt, just shaken up. The police come, reports are filed, and Mark calls his insurance company thinking, "This is why I have insurance." Here is where Mark's world begins to unravel. A week later, the estimates come in. The new Highlander he hit has extensive rear-end damage, including sensors and a liftgate. The repair bill is $19,000. The Lexus in front of it has trunk and bumper damage totaling $11,000. The total property damage Mark caused is $30,000. Remember his policy. It has a property damage limit of $25,000. His insurance company writes a check for $25,000 and tells him, "We've reached our policy limit. The remaining $5,000 is your responsibility." Suddenly, Mark has to write a check for $5 grand he doesn't have. His vacation fund is gone and then some. But it's about to get so much worse. The couple in the Highlander, a husband and wife in their 40s, were jolted pretty hard. The wife went to the emergency room for whiplash and severe back pain. She needs physical therapy for months. Her medical bills total $30,000. The husband has a sprained wrist and misses a week of work. His medical bills and lost wages come to $10,000. The driver of the Lexus has minor neck pain and a medical bill of $5,000. The total for bodily injuries is $45,000. Now let's look at Mark's policy again. He has a limit of $25,000 per person and $50,000 total per accident. For the wife with $30,000 in bills, his insurance pays the maximum $25,000. She is now personally on the hook for the remaining $5,000 of her medical bills, and she is not happy about it. For the husband with $10,000 in bills, the insurance pays the full $10,000. For the Lexus driver with $5,000 in bills, the insurance pays the full $5,000. So far, His insurance has paid out $25,000 plus $10,000 plus $5,000. That's a total of $40,000 for injuries. This is within his $50,000 per accident limit, so it seems okay, right? Wrong. The other driver's insurance companies and their lawyers see the situation very clearly. Mark caused the accident, and his insurance wasn't enough to cover the damages. They come after Mark personally for the rest. He owes $5,000 for the remaining property damage. He owes the wife in the Highlander the remaining $5,000 for her medical bills. He is now facing a lawsuit for $10,000. His $360 a year savings has turned into a five-figure nightmare. His wages could be garnished. A lien could be put on his assets. His financial future is in jeopardy because he tried to save the price of a decent dinner out each month. This is not a scare tactic. It is the mathematical reality of driving with state minimum insurance in 2024. The average new car costs over $48,000. A minor accident can easily exceed a $25,000 property damage limit. A single trip to the emergency room can exceed a $25,000 bodily injury limit. So what's the solution? A good, responsible starting point for liability limits that will protect a typical person is 100/300/100. That's $100,000 for bodily injury per person, $300,000 total for bodily injury per accident, and $100,000 for property damage. The jump in premium from the pathetic state minimum to these protective limits is almost always the best value in insurance. It might be that $30 a month Mark tried to save. It is the single most important investment you can make to protect your entire financial life from one bad moment on the road. Now let's talk about deductibles. This is simpler because it only involves your own car and your own money. This applies to your collision and comprehensive coverages. The deductible is the part of the repair bill you pay. If you have a $500 deductible and you cause $4,000 of damage to your own car, you pay the first $500, and your insurance company pays the remaining $3,500. The rule here is an inverse relationship. The higher your deductible, the lower your monthly premium. The lower your deductible, the higher your premium. Insurance companies are rewarding you for taking on more of the initial risk yourself. A lot of people automatically default to a low deductible, maybe $250 or $500 because it feels safer. But this can be a costly mistake. The only question you need to ask yourself when choosing a deductible is this: if I get in an accident tomorrow, what is the largest amount of cash I could pay out of pocket without it causing a major financial crisis? The answer to that question is your ideal deductible. If you have a healthy emergency fund with a few $1,000s in it, choosing a $1,000 deductible is one of the smartest financial moves you can make. Yes, you'd have to pay $1,000 if you have a claim, but you could save hundreds of dollars every single year on your premiums. Over 5 years without an accident, that could be over $1,000 in savings, effectively paying for your deductible in advance. On the other hand, if you're living paycheck to paycheck and coming up with $500 would be a genuine struggle, then paying a little more each month for a lower $250 deductible might be the right call for you. It's a form of financing your future repair bill. The big mistake is choosing a deductible you can't actually afford. Don't pick a $1,000 deductible just to get the lowest premium if you don't have $1,000. If you get in an accident, you won't be able to pay it to get your car fixed, making your insurance policy effectively useless when you need it most. Your deductible should never be higher than your emergency fund. So, to recap, for liability you go high. You buy as much as you can reasonably afford. 100/300/100 is a great start to protect your assets and your future from a devastating lawsuit. For your own car's deductibles, you choose a number based on your personal cash on hand, balancing premium savings with your ability to pay out of pocket. Getting these two things right, high liability limits and a manageable deductible, is the foundation of a solid, affordable auto insurance policy. But what happens when the other driver is the one with cheap state minimum insurance? And they're the one who hits you. Your high liability limits won't help you then. That's where a completely different set of coverages come into play, and ignoring them is one of the most common and costly mistakes people make. Imagine this scenario. You do everything right. You're a safe driver. You're stopped at a red light, minding your own business, maybe singing along to the radio. Suddenly, bam, you're violently rear-ended. The other driver was texting, didn't even hit the brakes. Your car is crumpled, your back is in searing pain. You end up needing months of physical therapy, maybe even surgery. Your medical bills climb to $80,000. You can't work, so you're losing wages. It's a nightmare. But you think, okay, at least the person who hit me has insurance. They're at fault. Their policy will cover this. Then you get the call. The driver who hit you only carried the bare minimum insurance required by your state. Let's say their bodily injury liability limit is just $25,000 per person. That's all their insurance company will pay. $25,000. Your bills are $80,000. That leaves a $55,000 gap. A $55,000 hole that you are now responsible for. Who pays for that? Do you drain your savings? Cash out your 401k? Do you sue the driver personally? Good luck with that. The kind of person who drives around with the absolute lowest insurance probably doesn't have $55,000 in assets to go after. So you, the responsible victim, are left holding the bag for someone else's recklessness. This isn't some rare freak accident. This happens every single day across America. And it's why the coverages we're about to discuss are, without a doubt, some of the most important dollars you will ever spend. I'm talking about uninsured and underinsured motorist coverage. Let's call them UM and UIM for short. Think of them as a shield. Liability coverage, which we discussed before, protects your assets from people you might injure. UM and UIM coverage protects you and your family from drivers who can't pay for the injuries they cause to you. They are two sides of the same protective coin. Let's break them down. Uninsured motorist coverage, or UM, kicks in when you're hit by a driver who has no insurance at all. Or in many cases, if it's a hit and run and the driver is never identified. Instead of being left with nothing, your own insurance company steps in and acts as if it were the at-fault driver's insurer. It pays for your medical bills, your lost wages, and even for your pain and suffering, up to the limits you selected on your policy. Now, underinsured motorist coverage, or UIM, is what would have saved you in that nightmare scenario at the red light. Covers the gap. When the at-fault driver has insurance, but their liability limits are too low to cover your expenses, your UIM coverage kicks in to pay the difference, again, up to the limits you chose. So in our example, the other driver's policy paid $25,000. Your bills were $80,000. If you had $100,000 in UIM coverage, your own policy would have paid that remaining $55,000, making you whole again. Without it, you'd be facing financial ruin. You might be thinking, what are the odds of this really happening? Well, according to the Insurance Research Council, on average, 1 in 8 drivers on the road in the United States is uninsured. 1 in 8. In some states, it's as high as 1 in 4. Every time you pull out of your driveway, you are sharing the road with millions of people who are breaking the law and have absolutely no way to pay for the damage they might cause. It is a massive rolling game of financial Russian roulette, and declining this coverage is like volunteering to play. Now, these coverages I just described, UM and UIM, are for bodily injury. They protect people. But what about your car? If an uninsured driver totals your brand new SUV, who pays for that? This is where uninsured motorist property damage, or UMPD, comes in. It's a separate but related coverage that pays to repair or replace your vehicle if it's damaged by an uninsured, at-fault driver. But here's a critical point you need to understand. UMPD often overlaps with another coverage called collision coverage. We'll dive deep into collision in the next part, but for now you just need to know this. Collision coverage pays to fix your car after an accident, regardless of who is at fault. So, if you already have collision coverage on your policy, you might not need UMPD. Why? Because your collision coverage would fix your car anyway, even if the at-fault driver is uninsured. You just have to pay your deductible. So why would anyone get UMPD? Couple of reasons. First, the deductible for UMPD is often much lower than a collision deductible. We're talking maybe $250 instead of $1,000. Second, if you don't have collision coverage, maybe because you have an older, paid-off car and decided it wasn't worth the cost, then UMPD is your only line of defense to get your car fixed without suing the other driver. However, some states don't even offer UMPD, bundling that protection into your collision coverage. It's a bit confusing, but the main takeaway is this: UM and UIM for your body are non-negotiable. UMPD for your car is a good idea, but check if it makes sense alongside the collision coverage you might already have. This brings us to the most important question: how much UM and UIM coverage should you get? The answer is shockingly simple, and it's a rule of thumb used by nearly every good insurance professional out there. You should carry UM and UIM limits that are identical to your bodily injury liability limits. Let that sink in. If you decided that you need $100,000 per person and $300,000 per accident and liability coverage to protect your assets from a lawsuit if you cause a crash, why on earth would you accept less coverage to protect your own health and your own family if someone else does the exact same thing to you? Are you and your family worth less than a stranger? Of course not. The logic is inescapable. Protecting yourself from the massive risk of an uninsured or underinsured driver is just as important as protecting yourself from a lawsuit. Match your limits. If you have $250,500 in liability, get $250,500 in UM/UIM. And here's the best part. This crucial, life-altering coverage is almost always incredibly affordable. We're often talking about just a few extra dollars a month to add this vital shield to your policy. It is, pound for pound, one of the best values in the entire world of insurance. Skimping on this coverage to save the price of a cup of coffee each month is one of the biggest and most dangerous gambles you can possibly make. The rules and requirements for UM and UIM do vary from state to state. Some states require you to have it. In others, insurance companies are required to offer it to you, but you can technically reject it in writing. Never ever do this. Never sign the form that rejects this coverage. That piece of paper is not a cost-saving document. It's a waiver of your rights to be made whole after an accident that isn't your fault. It is a self-inflicted wound waiting to happen. So we've now built a strong foundation. We've protected our savings and our future from lawsuits with high liability limits. And now we've built a shield to protect our health and our family from the alarming number of irresponsible drivers on the road with UM and UIM coverage. We've covered our responsibility to others and our protection from others. But we still haven't talked about the single biggest part of most people's insurance premium. We haven't talked about protecting the car itself from, well, everything else. From a deer jumping out on a country road, from a hailstorm that leaves it looking like a golf ball, from a thief in the night, or from that simple, embarrassing moment you back into a pole in a parking lot. That's where the two most famous coverages in auto insurance come into play. And understanding how they work is the key to not overpaying for your policy. Collision and comprehensive. They sound official, maybe a little intimidating, but they're actually pretty simple. Think of them as two different bodyguards for your car. One protects you from your own mistakes, and the other protects you from the chaos of the world. Let's start with the first bodyguard, collision coverage. The name tells you everything you need to know. This coverage pays to repair or replace your car if it's damaged in a collision with another object. That could be another car, of course, but it's also that light pole in the parking lot you didn't see. It's the garage door you thought was open. It's the curb you hit a little too hard on a tight turn. If you are at fault and your car collides with something, this is the coverage that steps in to fix your vehicle. Remember the liability coverage we talked about earlier? That pays for the damage you do to other people's property. If you rear-end a brand new Mercedes, your property damage liability pays for their repairs. But what about your own crumpled front end? Without collision coverage, you're paying for that out of your own pocket. Every single penny. That could be a few $100s for a new bumper, or it could be thousands of dollars, potentially even totaling your car, leaving you with nothing but a heap of metal and a car payment. Collision coverage is your safety net for your own vehicle in an accident you cause. But like any safety net, it has a feature you absolutely have to understand: the deductible. A deductible is the amount of money you have to pay first, out of your own pocket, before your insurance company pays for the rest. Think of it as your share of the repair bill. Deductibles for collision coverage typically range from $250 to $2,500. The most common are $500 and $1,000. Let's make this real. Say you have a $500 deductible. You back into that dreaded parking lot pole, and the body shop quotes you $2,000 to fix your bumper and trunk. You file a collision claim. You pay the first $500 directly to the body shop. Then your insurance company pays the remaining $1,500. If the damage was only $400, you wouldn't even file a claim because the repair cost is less than your deductible. You just pay it yourself. This is the first major lever you can pull to control your insurance costs. A higher deductible means you're taking on more financial risk yourself. Because of that, the insurance company rewards you with a lower premium. Switching from a $250 deductible to a $1,000 deductible can save you a significant amount of money every year. But, and this is a huge but, you have to be honest with yourself. Can you comfortably write a check for $1,000 tomorrow if you get into an accident? If the answer is no, then a super high deductible isn't a smart saving strategy. It's a financial time bomb. So that's collision, the bodyguard for your driving mistakes. Now let's meet the second bodyguard. Comprehensive coverage. If collision is for when your car hits something, comprehensive is for when something hits your car. It covers damage from almost everything except a collision. This is the coverage for the bizarre, the unfortunate, and the completely unpredictable acts of nature and humanity. A freak hailstorm pummels your car, leaving it looking like a golf ball? That's a comprehensive claim. A deer decides to play chicken with you on a country road at dusk and loses? Comprehensive. A heavy tree branch snaps during a windstorm and crashes onto your roof? Comprehensive. Vandals key your car or slash your tires? Comprehensive. And the big one. You walk outside in the morning and your car is just gone? Stolen? That is a comprehensive claim. Think of it as the life happens coverage. It's for all the damage that can occur when your car is just sitting there, or when you're the victim of circumstances beyond your control. Just like collision, comprehensive coverage also has a deductible. It works the exact same way. If a tree branch causes $3,000 in damage and you have a $500 comprehensive deductible, you pay $500, and the insurance company pays $2,500. Often, you can choose different deductibles for collision and comprehensive. Many people opt for a lower comprehensive deductible because the claims are often less frequent and not their fault. Now, we get to the million-dollar question. Or more accurately, the several $100-a-year question. Do you actually need both of these coverages? The answer isn't the same for everyone. First, the easy part. If you have a loan on your car or you're leasing it, the answer is almost certainly yes. Your lender or leasing company will require you to carry both collision and comprehensive. Why? Because until you pay it off, the car isn't just your asset. It's their asset too. It's the collateral for their loan. They need to make sure that if the car is wrecked or stolen, their investment is protected and the loan can be paid off. They're not going to let you gamble with their money. But what if you own your car free and clear? What if that title is in your name, sitting in your filing cabinet? Now the choice is entirely yours. And this is where you can make a calculated decision that could save you a fortune over the years. This is where you put on your financial advisor hat and analyze the risk versus the reward. The decision to keep or drop collision and comprehensive coverage boils down to a simple formula. The cost of the coverage versus the value of your car. Here's a widely used rule of thumb in the financial world. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's actual cash value, you should seriously consider dropping them. Let's break that down. First, you need to know your car's value. Not what you paid for it. Not what you think it's worth. You need its actual cash value or ACV. This is what an insurance company would pay you if your car were totaled. You can get a very good estimate for free from sites like Kelley Blue Book or Edmunds. Be honest about the condition. Is it excellent, good, or fair? Next, look at your current insurance policy or a quote. Find the exact cost for just the collision portion and just the comprehensive portion for a full year. Add them together. Now do the math. Let's say you have a 12-year-old Honda Civic. You own it outright. You look it up on Kelley Blue Book and its private party value is about $5,000. You check your insurance bill and see you're paying $700 per year for collision and comprehensive coverage. Is it worth it? Let's apply the 10% rule. 10% of your car's $5,000 value is $500. You are paying $700 a year to protect a $5,000 asset. That's well above the 10% threshold. In this case, you are paying a very high price for that protection. Over the next 2 or 3 years, you could pay over $2,000 in premiums to protect a car that's only continuing to go down in value. By dropping these coverages, you are essentially deciding to self-insure. You take the money you would have spent on premiums, that's $700 a year, and you put it into your own savings or emergency fund. If you get into an accident that's your fault, you'll have to pay for the repairs yourself. If the car is totaled, you'll have to buy a new one yourself. But you'll have been banking those premium savings all along. This is a personal decision based entirely on your financial situation and your tolerance for risk. If your car is worth $25,000, paying $800 a year for full coverage is a no-brainer. But if your car is worth $2,500 and the coverage costs $600 a year, you're paying nearly a quarter of the car's value every single year just for the insurance. That's probably not a wise use of your money. You could essentially buy a whole new similar car for what you pay in premiums over 4 years. Understanding this calculation, the value of your car versus the cost of insuring it, is one of the most powerful pieces of knowledge you can have. It separates the savvy insurance consumer from the person who just pays the bill every 6 months without question. It's how you stop overpaying for protection you may no longer need. This is how you take active control of your policy and tailor it to your life right now. But this only covers damage to your car. What happens when the person who hits you doesn't have insurance or doesn't have enough? That's a whole different kind of financial nightmare, and it requires a different set of bodyguards on your policy to protect you. This is where so many people get financially wiped out, even when they think they're fully covered. They build a fortress to protect others from their mistakes, but leave the front gate wide open for the mistakes of others to storm in. The two bodyguards you need to hire are called uninsured motorist coverage and underinsured motorist coverage. Let's call them UM and UIM for short. And trust me, these are not optional add-ons for the paranoid. They are non-negotiable essentials for survival in the modern driving world. Let's start with uninsured motorist coverage. The name says it all. It protects you when the person who hits you and is at fault has zero insurance. Nothing. Zilch. Let's paint a picture. You're sitting at a red light, scrolling through your podcast list. Suddenly, bam, you're violently rear-ended. The other driver is apologetic. They admit it was their fault. But when you ask for their insurance card, they just stare at their shoes. They don't have one. They lost their job, couldn't make the payment, and let it lapse. Now what? Your neck is killing you, your car's trunk is now part of the back seat, and the person responsible has no way to pay for it. If you don't have uninsured motorist coverage, you are in a world of hurt. Your health insurance might cover some of your medical bills, but you'll have to pay your high deductible and copays first. What about the weeks of work you'll miss while you recover? What about the physical therapy? Health insurance doesn't cover lost wages. And what about your car? Sure, your own collision coverage will fix it, but you have to pay your deductible, and you might even see a rate increase at renewal. Even though the accident wasn't your fault, you are literally paying for the irresponsibility of a complete stranger. But now let's rewind that scene. Same accident, same uninsured driver. But this time you have uninsured motorist bodily injury coverage on your policy. The moment you find out the other driver is uninsured, you call your own insurance company. In this situation, your insurance company essentially steps into the shoes of the uninsured driver's non-existent insurer. They will pay for your medical bills. They will pay for your lost wages. They will even compensate you for pain and suffering. They make you whole. If you have uninsured motorist property damage, it will pay to fix your car, often with a much lower deductible than your regular collision coverage, and in some states, no deductible at all. It turns a potential financial catastrophe into a manageable inconvenience. Think about the statistics. The Insurance Research Council estimates that about 1 in 8 drivers in the United States is uninsured. That's over 12%. In some states like Mississippi, it's over 29%. Florida, 20%. Tennessee, 20%. Every time you pull out of your driveway, you are sharing the road with millions of people who are breaking the law and have no financial backing if they crash into you. Opting out of uninsured motorist coverage is like playing Russian roulette with your financial future every single day. Now for its equally important twin, underinsured motorist coverage, or UIM. This one is a little more subtle but just as dangerous. This bodyguard protects you when the at-fault driver does have insurance, but they only have the bare minimum required by the state. And let's be honest, state minimums are terrifyingly low. In many states, the minimum bodily injury liability is just $25,000 per person. Let's go back to our accident. This time, the driver who rear-ends you is a college kid who proudly hands you an insurance card. You breathe a sigh of relief. But the accident was severe. You need an ambulance ride, an MRI, and maybe even surgery on a herniated disc in your back. Your total medical bills quickly soar to $80,000, not to mention the months of lost income. The college kid's insurance company is very polite. They process the claim and promptly send you a check for $25,000. Their policy limit. That's all they are legally obligated to pay. You are now left with a $55,000 gap in medical bills, plus all your lost wages. Where does that money come from? You could try to sue the college kid personally, but what are you going to get? His part-time job wages and his video game collection? You're stuck. This is how medical debt cripples American families. One bad day, one underinsured driver, and a lifetime of savings can be erased. But if you have underinsured motorist coverage, your financial nightmare ends. Once the other driver's insurance pays their $25,000 limit, your UIM coverage kicks in and covers the rest, all the way up to your own policy limits. If you have $100,000 in UIM coverage, it will pay the remaining $55,000 in medical bills and still have room to cover your lost wages. It's the ultimate safety net. It ensures that your level of protection isn't determined by the worst decision of the worst driver on the road. It's determined by the smart decision you made when you bought your policy. So here is the rule of thumb, the one piece of advice every single insurance expert will give you. You should always carry uninsured and underinsured motorist coverage, and the limits should mirror your own liability limits. If you chose to protect a stranger you might hit with $100,000 in bodily injury liability, why on earth would you give yourself and your own family less protection than that? If you have 100/300/100 for liability, you should have 100/300 for your UM/UIM coverage. It's that simple. You are just as valuable as the person you might hit. Protect yourself accordingly. The cost to add or increase this coverage is often shockingly small, yet the protection it offers is immense. Okay, we've built the main walls of our fortress. Liability protects others from you. Collision and comprehensive protect your car. And UM/UIM protects you from irresponsible drivers. But there's one more layer of immediate frontline defense we need to talk about. These are the coverages that act like medics on the battlefield, providing instant help without waiting to figure out who is at fault. I'm talking about medical payments coverage, or MedPay, and personal injury protection, or PIP. Let's start with MedPay. This is one of the simplest and most useful coverages you can buy. It pays for medical expenses for you and anyone in your car who is injured in an accident, regardless of who is at fault. It's typically sold in small amounts like $1, $5, or $10,000. Think of it as a small pot of on-demand cash for health expenses. Did you have to take an ambulance from the scene? MedPay can cover it. Do you have a $2,000 deductible on your health insurance that you have to pay before they cover anything? MedPay can pay that deductible for you. It's incredibly flexible and pays out quickly, often long before the at-fault insurance company even accepts liability. It bridges the gap and prevents you from having to pay out of pocket for immediate medical needs. Then there's its bigger, more powerful cousin, personal injury protection, or PIP. If you live in a no-fault state like Florida, Michigan, or New York, you're likely required to have this. PIP is like MedPay on steroids. Yes, it covers medical bills regardless of fault, but it also covers things MedPay doesn't, like a percentage of your lost wages. It can even pay for replacement services, meaning if you're injured and can no longer do things like cook, clean, or take care of your kids, PIP can help pay for someone to do those things for you. It is a comprehensive system designed to get you back on your feet quickly after an accident, without the delays of a traditional fault-based claim. Even if you're not in a no-fault state, some insurers in other states offer PIP as an optional coverage. If it's available, it is absolutely worth looking into, especially if you're self-employed or don't have robust short-term disability insurance through your job. It provides a cushion of cash flow when you need it most. So now look at the fortress we've built. We have the outer walls of liability, the armored garage of collision and comp, the elite bodyguards of UM/UIM, and the on-site medics of MedPay or PIP. This is what a truly fully covered policy looks like. It's a comprehensive shield that protects your health, your property, and your entire financial life from the chaos of the road. We've covered what all these pieces mean. We understand why they are critical. The final and most important question remains. Now that we've designed this perfect, impenetrable policy, how do we get it for the absolute lowest price possible? How do we take this ideal blueprint and find the one company that will build it for us for hundreds or even thousands of dollars less than their competitors? Because all the knowledge in the world doesn't matter if you can't afford the protection. Unlocking the true secrets to savings, the hidden discounts, and the negotiation tactics that insurers don't advertise. That is the final piece of the puzzle. And we are going to solve it right here, right now. Forget everything you think you know about discounts. Most people think they're automatic. They see a little line item on their bill for Safe Driver and assume they're getting the best deal possible. That is exactly what the insurance companies want you to think. The reality is your insurance policy is a treasure chest of savings, but the lid is locked. Most people don't even know where to find the key. The key is simple: you have to ask. You have to know what to ask for. Let's start with the most common, yet often underutilized category: driver-based discounts. You've heard of the good student discount, right? If you or a driver on your policy is in high school or college and maintains a B average or better, that's instant savings. But did you send in the report card? Did you resubmit it this semester? Insurers won't chase you for it. That's on you. Then there's the defensive driving course discount. In many states, completing an approved course can shave 5% to 10% off your premium for 3 years. It's a Saturday morning class that could save you hundreds of dollars. Think about the ROI on that. You spend a few hours learning to be a safer driver and get rewarded with a lower bill for years. But the biggest game changer in this category is telematics, the little plug-in device or smartphone app that tracks your driving habits. People are terrified of this. They're spying on me. Let's be brutally honest. Your phone is already tracking you. The difference here is that you get paid for it. If you are a genuinely safe driver, you don't slam on your brakes, you don't accelerate like you're at a drag race, and you don't text and drive. This is the single fastest way to prove it to your insurer. It can lead to discounts of up to 40%. It turns your good habits into cold, hard cash. Next, let's talk about policy-based discounts. This is the low-hanging fruit. The easiest win is bundling. Combining your auto insurance with your home, renters, or even life insurance policy is a no-brainer. The discount is significant, often 15% or more. But here's the pro tip. Don't just accept your current company's bundle price. Shop the bundle. Get quotes from 3 other companies for the combined package. Sometimes, even with a bundle discount, your current insurer is still more expensive than 2 separate policies from 2 other, more competitive companies. Do the math. Are you paying your premium monthly? Stop. If you can afford to pay for 6 months or a full year upfront, do it. Insurers charge administrative fees for monthly processing. Paying in full can save you 5% to 10% right off the top. It's your money, why would you pay extra just for the privilege of giving it to them in smaller chunks? The same goes for paperless billing and automatic payments. These are tiny discounts, maybe a few dollars a month, but they add up. It's about adopting a mindset of never leaving a single dollar on the table. Now for the secret weapon, affiliation and occupational discounts. This is where insurers hide some of their best deals, because they're not for everyone. Are you a member of the military, a veteran, or a federal employee? There are massive discounts for you. Are you a teacher, a nurse, a scientist, an engineer, or a first responder? There are specific discounts for your profession. Did you graduate from a certain university? There's likely an alumni discount. Are you a member of an organization like AAA, AARP, or even a wholesale club like Costco? They have partnerships that give you access to group rates. None of these are automatic. You will not see a box to check for alumni discount on the main quote page. You have to dig. You have to call and speak to a human being and say the magic words. Based on my profession, my education, and my memberships, what other discounts can you find for me? I once watched a friend save over $400 a year simply by mentioning they had a degree in engineering to an agent on the phone. That one sentence was worth $400. This brings us to the art of negotiation. You can't just call and demand a lower price. You need leverage. Your leverage is a competitor's quote. This is why getting multiple quotes isn't just about finding the cheapest option. It's about creating a bargaining chip. Here's the script. You call your current insurer before your renewal and you say, "Hi, my policy is up for renewal soon and I'm just doing my due diligence. I've been a loyal customer for 5 years and I'd really love to stay with you. However, I have a quote here from Progressive or Geico or State Farm for the exact same coverage, and they're coming in at $600 for 6 months, while my renewal with you is $750. Is there anything you can do to match that price or get closer to it?" Be polite, be firm, and emphasize your loyalty. This often gets you transferred to a retention specialist. Their entire job is to keep you as a customer. They have access to discretionary discounts that regular agents don't. They might find a loyalty discount you didn't know you had. They might rerun your profile and find a better rating. This single phone call can save you hundreds of dollars and it takes 15 minutes. And you must do this every single year. Loyalty is rarely rewarded with the best price. Insurers practice something called price optimization. It's a fancy term for slowly raising your rates over time, betting that you won't notice or that you'll think it's too much of a hassle to switch. Don't fall for it. Your annual insurance review is as important as a doctor's checkup. Now let's talk about 2 powerful levers you control directly: your deductible and your credit score. Your deductible is the amount you pay out of pocket before your insurance kicks in. A low deductible of, say, $250 feels safe, but you pay dearly for that safety in your premium. Raising your comprehensive and collision deductibles from $250 to $1,000 can slash your premium by 20%, 30%, even 40%. The question is purely mathematical. Ask yourself, do I have $1,000 available in an emergency fund? If the answer is yes, then you are essentially paying your insurance company hundreds of extra dollars a year to insure a risk you could afford to cover yourself. You're paying for peace of mind that you've already established with your own savings. Keep the higher deductible, put the money you save on the premium into your emergency fund, and you come out way ahead. Finally, the factor most people have no idea is crushing their rates, their credit score. In most states, insurers use what's called a credit-based insurance score to predict how likely you are to file a claim. Statistically, people with higher credit scores file fewer claims. It may not seem fair, but it's the reality of the industry. This means that improving your credit score is one of the most effective long-term strategies for lowering your insurance costs. You don't need to be a financial wizard. Just focus on the basics. Pay every single bill on time every time. Keep your credit card balances low, ideally below 30% of your limit. Don't open a bunch of new credit accounts all at once. Over time, as your score improves, your insurance rates will come down. It's a slow burn, but it has a massive impact not just on your insurance, but on your entire financial life. We've come a long way. We've demystified liability and deciphered the difference between collision and comprehensive. We've navigated state minimums and the crucial need for uninsured motorist protection. We've learned how to compare quotes like a pro, looking past the price to the true value of the policy. And now you have the final keys. You know the discounts to demand, the script to negotiate with, and the personal financial levers you can pull to command a better price. The power is no longer with the insurance companies. It's with you. You have the knowledge. You have the strategy. The only thing left is to take action. So here is your mission. This week, block out 1 hour. That's it. 60 minutes. In that hour, pull up your current policy declaration page, get 2 competing quotes online, and make 1 phone call to your current provider using the script we just discussed. This isn't just about saving a few bucks. This is about taking control of a major household expense. It's about refusing to overpay for a service you are legally required to have. It's about being a smarter, more empowered consumer. The confidence you gain from driving your car should be matched by the confidence you have in the policy that protects it. You've done the work. Now go get the savings you deserve.